Hi there, I'm Faure Heymans, Analyst here at RECM, and today I'm going to be talking about an article called Frack. In the beginning of 2012, the US natural gas price had dropped significantly from well above $12 per unit to below $2. This caught our attention and we decided to take a closer look. To give you some background, what had been happening in the States is that a new technology called fracking had revolutionized the industry. Fracking is a technique whereby a well is drilled down and then vertically across. The well is put under pressure with a mix of sand, water, and chemicals, and as it's put under pressure, it literally fractures the rock, releasing the gas as the water and chemicals are pumped back out. This had resulted in a large increase in the supply of gas. What we observed was a classic example of the capital cycle theory. This theory says that when there is an industry or a market where there are large returns on offer, either through growth or increase in demand or new technology, such as in this case, capital will flow into those industries. But what then happens is that the more capital flows in, the more supply increases. And with increased supply, you get lower prices. The lower prices then drive down returns, and eventually supply begins to leave the industry as capital doesn't earn a return anymore. A classic example of high prices being the cure for high prices. We took a look and we decided that the price of gas was unsustainably low for a number of reasons. The first reason being that oil and gas are used for the same thing, generating energy. And they've historically traded at a ratio of 6 to 10 units of gas per barrel of oil. Scientifically, it takes 6 units of gas to generate 1 barrel of oil, but because it's a regional market and gas is difficult to transport, this ratio tends to be a bit high. From there, we also looked at the costs in the industry. We looked at competitors' costs, studies done on the industry, and we felt that the sustainable price for gas was between $5 to $7 per unit. Obviously, at below 2, it was totally unsustainable. Companies were not going to be able to earn returns on capital, and therefore less capital would be going in. Supply would decrease, which would lead to higher prices. After looking at the various companies within the industry, we decided to invest in one of the lowest cost producers, a company called Ultra Petroleum based in Texas. That was in the beginning of 2012. Since then, our investment has done fairly well, but we feel that the investment case hasn't fully played out yet. Gas prices are now only at $4.50, where we feel normal prices are a fair bit higher, between $5 and $7 per unit. So as it stands, we're going to take a slightly longer term view on the price of gas, and we feel taking this longer term view will lead to superior returns for our clients.